Without any other delays, let's just get started. I'm going to hand it over to Greg, who is going to be moderating today's session with Gary and Scott. Thank you so much.
Thank you, Claudia. I'm Greg Milano, founder and CEO of Fortuna Advisors, and I'll be moderating this today. I've got a couple of slides I'm going to use to kind of set the stage and then get right into a discussion with Gary Bischoping, partner of Hellman and Friedman, and Scott Morrison, CFO of Ball Corporation. Gary and Scott, do you each want to just say a little quick thing about who you are so we can establish that and then move on?
Yeah, very good. Maybe I'll give it a shot first, Greg. So Gary Bischoping, partner here at Hellman & Friedman for about 4 months now. Prior to that, I was the CFO of a private equity-backed software as a service fintech for about 2 years. And then prior to that, I was the CFO at Varian Medical Systems, where both places we had the opportunity to work with Greg on residual cash earnings. And so looking forward to the conversation today, and thanks for the time.
And I'm Scott Morrison. I'm the CFO. I've been the CFO of Ball for the last 11 years. And Greg started working with our company before my time. I've been here 20 years, but he helped us put in EBA back quite some time ago. I think we're one of the longest companies using EBA and economic profits. So happy to be here.
Thank you both. Okay, so we will, without further ado, get into the topic. And if you can hopefully see the slides that we're presenting, I'll just have a few of them to get it started. And again, the topic is measuring, managing, and motivating owner-like thinking. And we all sort of come at it from a finance perspective in terms of our background, but we're going to talk a bit about how this affects motivations and culture. We'll talk a little bit about incentives. So we're going to cover a lot of different topics, as we go through this. And I think it's we really want to get the discussion going sooner rather than later. So if you think of things as I'm going through these introductory slides that you'd like us to answer, please, type them in so we can see the questions, and then, we'll try to answer as many as we can. My contact details are on the final slide, which I'll put up briefly at the end, which will allow you to reach out to us and ask any questions that you have. And if you have questions of Scott or Gary, I'll be sure to pass them on to them so they can respond to you as appropriate. But thank you all for joining today. With that, I'll go to my first slide here, where we talk about how is an ownership culture different from what typically happens inside of companies. On the left side, we have a lot of common things we see in companies, and on the right side, things that are more emblematic of an ownership culture, the kinds of things you see when a company has really embraced an ownership culture. So just starting from the top, in many companies we find there's a sort of use it or lose it type of mindset. If you've got some capital or expense budgeted, if you don't spend it, you're going to lose that, so you may as well spend it by the end of the year. Everybody manages very tightly to budgets. And in an ownership culture, people spend money like it's their own. If money is budgeted, but during the year it seems like it's not a good expenditure anymore, people don't spend the money. They underspend their budgets. And if throughout the year new things pop up that are really good ideas, they evaluate them carefully, but they're not hesitant to overspend their budget if there are really good ideas. They spend money, more like they would if it was their own. And one of the things I often ask managements when I first start working with them is, what would you do different if you own the company? If you take the top 10 or the top 100 or however you want to define management, and you say that team owns the company, what would you do differently? And that's basically what we want. We want people to spend money like it's their own. On the second line, we have, when we talk about sort of the allocation of resources and the number of initiatives and projects that happen, people often hedge their bets by sort of smearing resources kind of evenly around the organization, do a little bit of everything. And this way, whatever happens that's good, we make sure we're covering ourselves. In an ownership culture, there's much more of a focus on where value is really created, with what we call extreme prioritization of really focusing resources, where they do the most good. Much like an investor would think about, picking a portfolio of stocks. They want to pick the ones that are going to go up and not pick the ones that are going to be flat or down. And it's the same in an ownership culture when we think about initiatives. They really want to place big bets on the things they think are going to create value. In many companies, risk avoidance, which is a good trait, sometimes goes to an extreme where even good risks are avoided. And this often happens when there's an excessive focus on variances to budget. And in an ownership culture, we get more of a willingness to experiment and a willingness to fail, which we think it can be healthy, as long as obviously you're balancing, risk and reward to take good bets and not take bad bets. Many companies that have have really seen their innovation slide down to low levels in recent years. It's often because of this excessive focus on variances. People are afraid to plan for anything they're not 100% certain of, and that really limits the upside potential. On the fourth row, in many companies, and this is a very common trait we see in many companies we're talking to, analysis paralysis and indecisiveness take over, where people study things over and over and over again, and really have a hard time actually making a decision. And there's one thing I know that many founder owners that I've worked with have said things along the lines of, if I do something that has a $2 million net present value, but I spend $3 million making the decision, that's probably not a really good idea. So they become more decisive. They become, they focus on making sure they understand what they need to make a decision. Then they make a decision and they move on. They don't just keep studying things over and over again. So more doing and less talking. And lastly, and I've mentioned this a little bit throughout this, but most companies have a very short-term focus, which people like to blame on investors, and some investors are pretty short-term focused, I'll admit, but often the bigger problem happens inside the company. Because people are measured and rewarded based on variances to plan, they really are focused on making sure they hit plan, and very often at the end of the year they do things which are not in the long-term interest of the company in order to hit their plan. They cut R&D, they cut marketing, they cut training of employees. They'll offer a discount to pull sales from January into December, even though that's not good for the long term of the business, just so they can meet the short-term plan. They know they can, negotiate a new plan for next year. But in an owner-like culture, it's not that short-term focus, but it's not only long-term focused either. It's really a good balance between the two. Owners that I've worked with are very eager to drive short-term performance, produce as much cash flow and profit as they can in the current year, but they would never get there by cutting R&D, for example, or reducing advertising of important brands or something like that, things we see very often in public companies. And so it's about the long and the short term, always about both. So with those principles in mind of an ownership culture, one thing that sort of caused us to want to talk about this today is the fact that both of our panelists have used some form of an economic profit measure, which is a much more complete measure of performance than what most companies use. And just to explain how economic profit works, for those of you not familiar, traditional economic profit is NOPAT based or accrual accounting based. Our more newer version uses a cash basis of earnings, but in either case, there's a measure of the output on the P&L, so to speak, without any cost of financing. And then we subtract from that a capital charge for the operating assets in the business. When we're using NOPAT, we use the net operating assets in the business. When we're using cash earnings, we use the gross operating assets in the business. But the important thing here is that the balance sheet is being charged against the P&L. So we now have a very complete measure that captures growth, that captures margins, it captures capital productivity, all in one measure. And as I like to say, when it goes up, it's good. When it goes down, it's bad. Because it captures everything. You can make trade-offs between margins and growth and investments, and everything kind of comes out in the wash, as they say. And this measure of economic profit kind of brings it all together. And the changes in economic profit from year to year have a strong relationship to TSR, stronger than most accounting-based measures. So we have a lot more confidence not measuring it against plan, but measuring it against some definitive way to set targets based on prior performance. So we're always focused on improvements, not variances, and that has a big impact on all the behaviors I talked about on the prior page. The last thing I'll show here is for companies that take this very seriously, it becomes the kind of centerpiece of their business management framework. How they set goals, how they plan, how they make decisions, how they look at acquisitions, for example, how they pay incentives, and even how they communicate with their investors is all driven by this economic profit measure. So I just wanted to cover these 2 pages to provide a little bit of a kind of intro. And then with this, I'll now maybe ask a couple of questions to my colleagues to let them kind of comment on their use of these kinds of measures and what they've seen. I guess, first, Gary, I'll turn it to you. What do you think are the really big benefits of using an economic profit measure from the inside view inside a company?
Yeah, thanks, Greg. And just to reiterate, we had the chance to put this residual cash earnings metric in with Greg and the Fortuna team when I was the CFO at Varian Medical Systems, publicly traded company at the time, about $3.5 billion in revenue, market cap of about $9 billion when I got there, and kind of $14 billion when I left. And I think some of what I observed in working with Greg and the team to put this metric in is that simple concept of when it goes up, it's good. When it goes down, it's bad. And it brings all the other kind of balanced scorecard. What do I think about EBITDA? What about revenue growth? What about earnings per share? It brings all of those other kind of decision-making metrics all down into one thing that you can train and educate an organization and a leadership team on that enable them to make really good decisions going forward that balance the short term and the long term. And I'd say that's so one is it's simple, up is good, down is bad. 2 is, I think, that it helps you balance that short-term, long-term ownership mentality. And because of how you could deploy this in pay, where it's a continuous improvement in residual cash earnings over time, you start to get to think teams and leaders to think about how they invest over different horizons to sustain long-term growth, as opposed to what do I just need to do to hit next year's budget, because that's how I'm going to get a majority of my payout. So I think it provides the right incentives when deployed accordingly. And the third part is you can follow this all the way through to the buy side of your investor base. While I was out on the road talking to our top 30 investors about making this move, 8 to 10 of them turned a screen around and said, look, this is, a residual cash earnings or economic profit metric is one of the things that I use in determining to invest or not invest when I'm making an investment decision. So it goes all the way from simple to the right incentives to, your shareholders are typically aligned, at least the long-term buy-side crowd that hopefully are in your stock consistently with that outcome.
Scott, on that topic, anything you want to add about your experience at Ball over the years?
Yeah, I would say I would agree with everything Gary said. We always joke that it makes the meeting shorter because we're really focused on economic profit for us, EVA. That is the financial filter that we use. So, you get one of those investor decks on an acquisition or something, and we go to usually about page 15 and say, okay, what's the EVA this is going to generate? Is it positive? How much? What's the risk? It's how we get paid. And I think creating that ownership mentality is incredibly important to get people to buy into this. And it takes away a lot of the BS that happens in budgeting processes and things. And to the point on investors, we've been tracking this since 1992 when we put it in. And we have a 92% correlation between the EVA dollars we generate and to our stock price. And that's through any kind of a market that we've seen, any kind of crisis that we've seen. And so we know it works. We are true believers. And that's kind of the first thing when you become a new employee is we indoctrinate you in this mentality because this is how we run our business. It's how we decide on acquisitions, divestitures, buying our stock. It runs through, it's really the lifeblood of our business. So we find it to be pretty simple and pretty complete.
Excellent. Gary, I know when you were at Varian, the company made a number of acquisitions, actually turned down one important acquisition that was being considered, and made some significant changes in general to how capital and other resources were allocated. Can you just give us kind of a rundown on some of the important points in the area of capital allocation?
Yeah, and just a little bit of context. When I got to Varian, Varian market share leader in their industry, and 55, 60 points a share. And the company had been growing about 2 to 3%. And when you kind of just step back for a minute, they're the market leader, and why aren't they growing the industry? And they work in the radiation therapy device space, and unfortunately cancer is not slowing down around the globe, and so there's no reason why we shouldn't have been growing 8, 9, 10%, unfortunately. But the reason is because they were underinvesting in both inorganic as well as organic growth. On the organic side, R&D was being treated as a period expense. And in that world, in that industry, your R&D is spent over a 4 to 5 year period. And then the product life cycle is 8 to 10 to 12 years long. So if you miss a cycle, you're really set back for a long time. And so immediately we unlocked value by repositioning capital allocation into what was a burgeoning software business that was growing very fast, but incredibly underinvested in. And so we literally doubled the amount of investment, accelerated one of those organic options, growth options, that we brought to market in a year and a half as opposed to a 4 year period of time. And that created organic growth to go from 2 to 3 to 6 to 8. And so that literally was there to be done, and it was just the wrong incentives. You know, what they were doing was actually cutting R&D to make a quarter or a year. And the right thing to do was to double down on that software outcome and go drive that new product. So that's kind of one on the organic side. Inorganically, we had the opportunity to buy, you know, a new technology that had been worked on for kind of 10 to 12 years in the industry, and a company had brought this to market. And the question we were toying with was to buy or not buy, or build. And the buy case needed to show and demonstrate that this new technology wasn't just going to be a niche. And so, you know, we made an offer for the company. They did not accept the offer. We countered a little higher. And then the company, the target actually did come back and say, here's what you need to get to close the deal. And literally on a whiteboard in my office with the CEO, we came to a no answer by doing, you know, kind of the update to the economic profit analysis that said, you know, under no scenarios do we think we can earn the appropriate amount of earnings over time, residual cash earnings over time, to cover that cost of that acquisition. So we said no. Subsequent to that, we bought 6 companies entering the interventional oncology space to expand into a near adjacency. And those were wildly successful acquisitions over the following 2 years, and took our growth from kind of 6 to 8 to 8 to 12. So I'd say it provided that right balance of, yes, you still need to invest. It's not an automatic no because you have the cost of capital in there, but it is a better litmus test than just on trying to get more revenue or EBITDA or EPS accretion.
Thanks, Gary. Scott, Bohl has been using EVA for almost 30 years, probably the longest running user in the world. And during that period, you've made very significant investments, often acquisitive investments. How has management made sure there's a focus on investing in growth over the years, in order to continue to drive value?
Yeah, it's really, again, EVA being the primary filter, we've been around for 140 years. And, most people know us historically from being in the glass business. We got out of the glass business because after we adopted EVA, we realized we were never going to earn the kind of cost of capital and get the returns that we needed to pay for it. And so we divested really what was our history and looked at our businesses and said, hey, we really have a great two businesses, in our aerospace business, but then our beverage can business, and we can earn great returns in the beverage can business. And so that set us on a 20-year path of acquiring and basically becoming the consolidator of the industry, where we knew we could put capital to work and earn great returns. And over that time, it led us to sell, not only our glass business, but we were in a plastics business that didn't earn positive EVA dollars. We were in a food can business that didn't. We were in China that didn't. And we got rid of all of those businesses over time in a disciplined way and invested heavily in our beverage can business, where we could deploy that capital and earn greater returns. And that's really led us to, kind of growing our market cap over the last 20 years from 700 million back when I joined to 30 billion now, of allocating that capital in the right way. And I always tell people, you think the acquisitions we did were really smart. The things we didn't do were even smarter. And again, that went through EVA filters where we said, we either can't pay this much or we can't earn returns over time, and it's not worth doing. And sometimes I think the things you don't do are the best things you could do.
Yeah, that's great. I was asked recently whether these frameworks actually motivate more acquisitions or less acquisitions, and my answer was you become more motivated to do things you really believe in, and also more motivated to not do things that don't seem to be able to create any value. There are so many case examples of people overpaying for what were otherwise good acquisitions, and I think this provides a lot of discipline around that process. And both of your companies have shown that it doesn't stop acquisitions from happening. It just gives you a better filter on which ones you should do. One of the other comments that I often get when people are asking me about, whether these frameworks really work is, how do you really educate people, not just at the senior level of the organizations, not just in finance, but, operating people and so forth. And so I guess, before we go to anything else, I'd be curious, maybe we'll start with Scott this time and then go to Gary. What do you think are the important things to consider to be able to educate people on how to use these measures to make decisions?
Yeah, I think to Gary's point, try to keep it as simple as possible. I mean, we use exactly what's up on your slide here of how you improve EVA dollars is you grow NOPAT, you have smart growth that's covering your cost of capital. We do simple examples on your balance sheet of, if your receivable days are 45 and you take it to 30, what that means, or payables kind of the opposite direction. And so we do really simple examples for our general population to show how simple this can be. And it's really not, when you boil it down, it really isn't that complicated. And so educating we've hired a lot. We've hired, I think, close to 4,000 people during COVID in the last year and a half across our businesses. And this becomes a first and fundamental thing, is teaching EVA why it matters and how you can affect, no matter what job you have, how you can affect EVA and the decisions that you make. And that ownership culture is a big part of that. But trying to keep it as simple as possible, we find is the best thing. You don't have to get into whack and all the calculations and things. You just try to make it very simple.
Yeah, maybe just to build on that, Greg, in that simple theme. I mean, when we rolled this out to our top 100 executives, we did a simple laundromat example, and we kind of animated it and made it a little bit of fun, And so, if you start up a laundromat, you got to buy a building, and you got to put some equipment in there, and then how do you play with different pricing and work pricing in over time, and what do you do about maintenance, and just simple concepts built around a laundromat example that you can start to get people to think and act like an owner, which in the end, that's what you want. If it's your business, what would you do, right? And you could take your capital and put it in something else with equivalent amount of risk, like you would expect a return. You wouldn't say you got a good return on that until you got a return above what you would expect. So simple concepts built around a laundromat example. And then I'd say the second part was making it real. So as we went through our strategy process, right, to evaluate new initiatives, we used economic residual cash earnings as the barometer to determine not only kind of what made the cut, but how would we prioritize those investments. And now an operator is side saddled with a finance business partner, an HR business partner. They got to build that business case together, right? And then they have to deliver it if that's really going to be what we're going to go spend our time on. And so when they start to practically use it for resource allocation, then in our case, we had an offsite for a day and a half. We had 20 ideas come forward, 10 kind of made the initial cut, and those business operators presented the residual cash earnings business case and the things that came with that. And then we used that at the end of the, kind of the first day to determine of those 10 things we're going to invest in 4. And so it really helped the operators to get their hands on it, feel it, work it, and move forward.
Yeah, I think if I go back in time to the early 90s when I worked with Ball and other companies, a lot of times back then we spent most of our time trying to explain the sort of financial economics of the measure to people. And I think what we've learned over time, and I think both of these companies have learned, is it's really more about teaching people how to use it to make decisions and giving them case examples so they get practice with different types of decisions that they might face. And then when they have to face the decision in the real world, they at least have some sense of how to frame it, in this measure. There's definitely something that requires, a good amount of training. I'm going to, just from the questions that have come in from the audience, I'm going to ask one more question. We're going to be losing Gary to a board meeting halfway through. So I'm going to ask you one more question, Gary, before you go. And it's in the context of the more recent software company you worked with was privately owned. And the question was, how do you convince a private owner to accept more of an ownership type mindset or a partnership type mindset between the owner and the management and the employees? And, what's your experience with that? And obviously it's a very important question too, since you're now working in private equity. So
yeah.
maybe you can respond to that.
Yeah, well said, Greg. And that ownership mentality drives through a partnership model, I think, even faster. So, no offense to public companies in the world, but it took me a little bit of time to get the board, over the idea of how this makes sense and how it works, and from a residual cash earnings perspective. At that private company, I got that done in about 3 months. And really the idea that this goes up, it's good, it goes down, it's bad, really resonated. It was simple. It kind of trumped the EBITDA mantra that was running in the company. And when I showed our private investors, as a private equity firm, that we were investing in things that would never get an adequate return relative to what they would expect to have a return on, they immediately got aligned to this metric. And then in terms of comp, same thing. They were willing to move this to a material portion, more than 50% of the comp plan, and in order to drive that right alignment with them. So they liked the fact that when it went up, it was good. When it went down, it was bad. They liked the fact that I could show them a handful of examples where we weren't making the right decisions, because even though we were getting more revenue and EBITDA, we weren't getting enough relative to the cost to then move that forward. And the last piece is we demonstrated where we were underinvested in the business to drive different resource allocation decisions around our platform and portfolio. So, I think it also balanced the horizon for them. Private equity firms typically have a horizon, but they still need to make sure that they have a reputation to build on in the long term. And if they're out shopping assets that don't yield returns for buyers over time, that won't get you very far in the private equity world either. So it really is that long-term ownership mentality, and part of what attracted me to Hellman & Friedman is to start to bring that forward more in the private world.
Great. Thank you, Gary, and thank you for your participation. Scott, I'm going to turn to you now with another question from the audience. The question was, when looking at days of sales outstanding and receivables, do you apply a full weighted average cost of capital or some sort of market cost of factoring with no recourse? The person said that they think the full WACC can lead to a bad answer as the risk is less than for the business as a whole. I have a response to this, but I'd like to hear your response if the question was directed at you.
Sure. We do not. We've looked at breaking it down more granularly to concepts like that, but we think just keeping it simple, using a consistent cost of capital across all the assets. We do vary the cost of capital target based on risk of, certain countries obviously have more risk than others. So we do tend to do it from that perspective. But in terms of, going through the balance sheet and breaking it down further, we don't do that. In concept, it does make sense to do that, but we try to keep it pretty high level and pretty simple and not do that. Now I'll be curious how the expert says we should do it.
Yes. Keeping it simple is something that is really important to me. And also, the most important part of this is not the decision-making, it's the accountability for economic profit, whether it's EVA or residual cash earnings, going up versus last year. And by the time it's an actual, all the risk is gone, right? At that point, it's an actual. So we think using a consistent required return or cost of capital across all the assets is a really good idea. Now, that doesn't mean when you're making a decision, you shouldn't maybe adjust it, especially for higher risk items, to account for the fact that, the likelihood they're going to turn into actuals is lower. Than work with companies that have operations in very risky countries and things like that, where we're at the decision point, we've used higher hurdle rates, but still for performance measurement after the fact, we use, one single measure in virtually all the applications that we've done. And just one more comment about this, even at the time of decision, I prefer, when you have high risk situations, I prefer doing more scenario analysis of what happens if it's successful, what happens if it fails, what is the minimum probability of success we need to believe for this to be a good idea, rather than just trying to use the blunt instrument of a higher hurdle rate, because there you don't really get to understand what are the drivers of success, whereas looking at the probabilities really helps. And as far as the specifics of the question around working capital, it's true, lots of working capital, you can find lower cost ways of freeing up the capital, but the way it's used in credit analysis and the way it's the money is fungible across different types of assets, I think the real benefit of oftentimes freeing up working capital, is that you can invest more money in more productive assets. And so, certainly there's a theoretical answer that says you can use a lower cost of capital for these lower cost assets, especially, very liquid, high quality receivables and things like that. But in practice, virtually every company I've ever worked with doesn't make that distinction and uses one hurdle rate and winds up overall having better result as a consequence of the simplicity of it. I'm going to turn now, Scott, to a very different topic, since that question kind of led me into incentive discussions a little bit. One of the important things, which I mentioned briefly in my opening comments, is how incentive targets are set. Many companies, unfortunately, measure variances to plan, and what they wind up doing is encouraging people to plan low. And as I like to say, why pay people to plan for mediocrity? How does Ball set performance targets in incentive plans, EVA performance targets in incentive plans, and how do you think the approach you use affects people's behavior?
Yeah, ours, we've been doing this a long time now. So really the targets are self-setting. It's basically, if your target one year, just a real simple example, was 100 and you produced 110, your next year target is 105. It's 50% of the amount you outperform. If you lower performance, it also adjusts down. And there's leverage factors and things. So I'm not going to get into that, but essentially it's a self-setting process. So we don't really do a budgeting process. We do an annual operating plan, and that spits out a particular EVA return and EVA dollars generated. And people know that if they can increase the EVA dollar generation, they're going to get paid more in their incentives. It's very clear to them, what kind of payout factor they're going to have. And so we don't get into the whole budget and negotiating budgets. And it's been interesting because when we've made acquisitions where companies had done that in the past, we bring them in pretty quickly and say, this is how you're going to get paid. We set a target initially based on what we paid for the business and how much invested capital is there. And frankly, we try to set an initial target where they can earn greater than a one-time payout, because we want to get them kind of incented and understanding and buying into how we're going to do this going forward. And then we give them all the different tools that we've used over time where we've generated EVA dollars, both in your P&L and through your balance sheet. And, here's a bunch of different ways in which we've done it. What makes sense for the business that we've acquired, and hooking people early to that, and then that self-setting mechanism. We think it takes out a lot of the bureaucracy, it takes out a lot of wasted time, and it takes out a lot of the negotiation of, does one guy negotiate his budget better than another guy? That shouldn't be how you get paid. It should be on actual performance of generating increase in EVA dollars.
Virtually every incentive plan I've worked on in the last 20 years has had an automatic target setting mechanism like that. Some basis off of last year or some combination of last year's target and actual. And I agree with you, it has a huge positive impact on behavior. And just one little story from another client, after we had implemented this, we were in a plan review and one of the business unit heads was presenting, and the CEO said, I was speaking to some of my people and they suggested that you could pursue this, this, and this, which would help, improve your performance, for the future. And the person, immediately started hedging and didn't want to put those new ideas in their plan because in the old world, that would be raising the target. And in the middle of his, sort of response, the CEO said, before you go any further, bear in mind that if these ideas work, we all get paid. We all get paid more. I'm not asking you to raise your hurdle. The target is based on last year. And if we achieve more, you get paid more, I get paid more. Remember, we're partners now. We're not on other sides of the table negotiating performance targets for you. We all get exposed to this measure. And if it goes up, we all get paid more. If it goes down, we all get paid less. And what happened at that company was much greater transparency of information up and down during the planning process. Things people would keep in their back pocket before to make sure they could protect their ability to perform during the year by doing some things they never told anybody about. None of that really happens anymore, or at least not as much as it did before, because people could become much more willing to openly talk about opportunities, again, because everybody's kind of on the same page.
Yeah, I would agree. I think that alignment, our EVA incentive plans, I have the same EVA incentive plan as somebody that works in one of our plants. Now, my percentage of pay is much different, but it's completely aligned from top to the bottom. And I think that alignment creates that transparency. It helps you understand your business way better. And I think, again, that's another thing that just cuts out a lot of wasted effort that a lot of companies spend time on where it's not very productive.
Yeah, and the fact that Ball has been able to stick with this framework for approaching 3 decades is really impressive, and that consistency itself really reinforces the sort of commitment of management, and it really gives people confidence that if they make an investment now, which maybe causes the current performance to dip a little bit, but they believe strongly in the payoff in the future years, they have confidence that the rug isn't going to get pulled out from some negotiated target setting process. They can do the math. I'm giving up X $1,000 now, and I get 3 times that over the next 2 years if I'm right about my forecast. Creates a lot of discipline. Before people even recommend a new investment, they think long and hard about whether or not they believe it themselves. One more question related to this, and you alluded to it as you talked about the people that come in from acquired companies and people in business units and so forth. But just on the last point that I made, what kind of accountability, sort of maturity in the resource requests do you see within the business, the leadership of business units of the company? I mean, do they really seem to treat the capital like it's their own money and really be only willing to put forth investments they really believe in? Is that something you see?
Definitely. I mean, somebody asked me once, how often do you turn things down from an EVA perspective? I had to think about it. Frankly, not very often, because early on when we've acquired some things where people are still getting their heads around this, how we're going to do this and how disciplined we are and that we don't stray from it. I remember being in a review one time and this business unit wanted to invest in a particular area, and we looked at the EVA returns and they were generating virtually no positive EVA dollars. And we just kind of looked at each other and said, do you really want to work this hard to not make any more money? I mean, that just doesn't seem like it's worth it. And, so that has happened, from time to time, but I would say it galvanizes people exactly on, we don't do, we've seen companies where they said, we're going to spend X percent of depreciation on CapEx. No regard to what the returns are. I mean, that to me is just a foolish way to allocate capital. Ours is really built from the bottom up, and we don't allocate. We don't say we're going to do 300 million of acquisitions this year or 300 million of capital this year. Everything has to stand on its own and be self-supporting from an EVA generation standpoint. And so, if we have $1 billion like this year, $1.5 billion worth of opportunities to spend our capital to grow our business, deploy more capital, we're doing that because we firmly believe in the returns that we're going to get and the increase in EVA dollars that we're going to get over time. And so it really makes it much more simple to allocate capital, make decisions.
Yeah, that's really great. I've seen that many times, and I've also, seen how it just changes people's perspective. Some companies that I've worked with have set capital budgets very arbitrarily, and when you ask why, somebody will say, "Well, that's what we told investors." That's in our guidance, and so we don't want to go over that because then it looks like we can't manage a budget. If a great idea comes along, why wouldn't you make the investment? And if something you had in your budget suddenly doesn't look so good anymore, why would you still spend the money? It's just an owner is much more responsive to the dynamics of the market rather than being fixed in these annual increments with artificial thresholds and so forth. But we have another question. I'm sorry, go ahead.
No, I agree 100%. In fact, we've been able to buy, I won't mention the company because it was public at the time, but one of our acquisitions, they were focused on market share and with no regard to the economic profit that market share was getting them. And I always told people that said, why we got to buy this company was they were focused on market share and we were focused on EVA dollars. That's why we got to buy them, because we were focused on the right things, because they were spending money and not getting the returns for it.
Yeah, it's very true. The next question comes from the audience, and it goes into the incentive area again. And I think knowing a lot about ball, this will be sort of slow pitch softball for you, Scott. It says, in your incentives, do you set hard upper and lower limits? In my experience, these create game playing. If you made the upper limit, you could spend ahead to make next year as well. And there's similar disincentives if the lower limit is met. What do you say about sort of compensation limits in your use of EVA at ball?
Yeah, I think if you had limits, you'd get exactly that behavior. Ours is unbounded. It's unbounded on the upside and it's unbounded on the downside. And so if your incentive, if somebody can get a 2-0, if they can get a 2-5 or a 3-0 payout, they're going to get paid that payout. And conversely, if it's going the other way, they're going to feel the pain of that. My first year at ball, I joined and I was the former CFO, who Greg knows well, Ray Seabrook, said, this is what our incentives have paid out over time. Historically gave me all the numbers. And in our first year, our EVA dollars dropped. We weren't performing very well. And so, no bonus. And that's a tough pill to swallow, but it galvanizes people around, okay, what do we need to do to fix this? And I think having it unbounded takes away the game playing and, we made our budget, so we're not going to do anything more. We want people thinking about this 365 days a year and pushing the business 365 days a year. And I think having those unbound both up and down creates that kind of that ownership mentality and that entrepreneurism.
Yeah, that's great. It's really a great way to align owners and managers to put them in the same, in the same boat on that. There's really no cap on how high a share price can go.
Right.
Obviously, it needs to be calibrated so that you can't just on a whim hit 3 or 4 times your bonus. It's got to take real value creation, but you know, it's great what Ball has done in that area. I think it's clear to people how these kinds of incentives encourage cost efficiency, you know, good pricing, capital productivity. But over the long term, it's very important to also be innovative and, you know, to experiment a bit. And I'm curious, you know, what has been your experience specifically as to how this has impacted the company's willingness to spend money on innovation projects and the effectiveness of those projects?
Yeah, I've heard, you know, that's one of the criticisms, I guess, I've heard of EVA or economic profit over time. What we do is, and it might be a little bit customization, but to avoid that is basically, if we're going to spend money on innovation, even if it's in the P&L, we're going to capitalize that investment, and then there's a bleed-in period of that investment, so that over a 3-year time horizon, you've got to earn that capital. You got to earn a return on that capital, and so we think it was more of as a capital charge, if you will, than a P&L cost, because these are investments that, you know, hopefully will, you know, generate returns for a long time. So we've never had. I don't think it's really killed a lot of innovation. I mean, we've been very innovative. We now, you know, when I joined the company 21 years ago, you know, we made a half dozen sizes of different cans. Now we make 40 different sizes. I mean, we've spent a lot of money on innovation. We just came up with a new aluminum cup, where it's, you know, 100% recyclable aluminum cup. This was innovation where we spent a fair amount of money on it, but we capitalized that, and then we'll expect to get a return over a long period of time on it. So for us, it hasn't dampened our willingness, because people see the long-term returns that you could get on a new product. And if you can truly create something new and different, you're going to like that payoff over a long period of time. You know, that's why I think the view of, you know, it's not just about the next quarter, it's about 2 years from now, 3 years from now, 5 years from now. That's where you need to continue to reinvent your business to keep that growth going.
Yeah, that's great. And just since Gary had to drop off, I'm very familiar with the Varian approach, and he alluded to it before, but they, at Varian, in their measure, all of their R&D was treated as capital as well, just like what you're suggesting. In their case, based on some research we did around the industry, we used an 8-year life. And so, you know, you'd be paying a capital charge on your R&D spending for 8 years. And what we find in working with many companies over the years with that particular aspect of this measure is people become more willing to invest when they have a good idea, but also they become more willing to stop investments that are clearly not working out. You know, if you know that whatever you spend money on now, you're going to get a capital charge for the next 8 years, you can't just forget about it next year because you wrote it off as an expense. It actually sharpens the focus on stopping projects that are bad. I said a long time ago that one of the greatest things about Silicon Valley is not the ability to fund great ideas, it's the ability to unfund bad ideas. And I think the same holds true here. When you're going to be charged for this as a capital item, it actually gets you to stop spending on bad things quicker. So it helps really focus the resources in the areas where it does the most good because of the behaviors that it motivates. So there was also a question from the audience. Please comment on the role of HR, R&D, which I guess we just kind of talked about, and marketing in developing the resource base of a company such that it can generate sustained outperformance. I have some thoughts on that, but do you have any thoughts on that, Scott, that you'd like to add from the vault?
I mean, definitely HR. HR is, you know, as I mentioned, we've hired, I think, 3,800 people during COVID. So continuing to source talent. I mean, you know, everybody talks about a war on talent, a war for talent. You know, clearly to continue to bring people into our organization, people to buy into this kind of concept. Again, we don't use, you know, the balanced scorecards is not how you're going to get paid. It's really going to be the EVA dollar generation of your business unit and then the corporation in total. So HR plays a really important training, both acquiring talent and then training talent so that all this new talent coming into the organization understands what the drivers are, how you get paid, how we're going to get paid, how we're going to be successful. So I think they play a real critical role.
Good. I just want to comment on the marketing part side of this question because I've worked with a number of consumer products companies now. And one thing I've seen is a shift over time from more brand building advertising, which has more long-term value, to more spending on things that really promote in the short term. Again, this is consistent with this, sort of hyper focus on quarterly earnings. Companies are unwilling sometimes to reduce promotion and put it into longer term, brand building advertising because they really can't handle the short term hit they'll take, when they pull the plug on some of the slotting fees and other forms of short term, spending. But over time, the investments tend to pay off. So marketing plays a big role, especially in companies where the consumer is the customer, but obviously also when you have B2B, in trying to drive value and helping to create and also to illustrate to the buyers, just what the sources of differentiation are. I believe firmly that economic profit only comes from being able to differentiate. And even if you're very efficient, if you don't have differentiated products and you always have to compete on price, you're going to have a hard time growing economic profit. So the role of R&D and HR in developing good talent and marketing and developing good branding, these functions are very important in developing the resources of the company. The last question we have from the audience that I see here is a little different. It says, how have you attracted Gen X and younger staff to want to become owners, or to at least, sort of act like an owner in the business and have that kind of a view culturally on the company? Do you have any experience to talk about with regard to that, Scott?
Yeah, I mean, a lot of our new hires, I'm kind of the old guy now, but a lot of our new hires are young folks. And what we find is, especially today, especially kind of given the political climate that we live in, the uncertainty of the world, we really believe people want to be part of something bigger than themselves. And we think that ownership mentality and our ownership culture really can be one of those things that attracts people. I think that's one of the reasons we've been successful at hiring a lot of people, is we believe that. We live it. It's not a company where, you're going to hit it out of the park one day and make a bunch of money. It's going to be over a long period of time. We think we can be successful. And so we need people that come in and want to be part of something bigger than what they are. And clearly there's generational differences in how they value their time off and flex time and all that kind of stuff that you have to work through. But we really have not struggled with people coming in and being part of something bigger than themselves. Even though you hear a lot of things about how big business is evil and things, but we believe we really are trying to attract the right kind of people that buy into our culture, that buy into this mentality, and I think that consistency has helped us attract people over time, and we really haven't struggled with any generation of that. And I think they've also seen the people that have been around here a long time, have done really well. We've got over 1,000 participants in our 401k plan that have $1 million plus balances. So they've seen people that have been here a long time become very successful by buying into this and being part of it. And I think that helps too.
Yeah, I think that's, I think you raised a lot of good points there. And I think some of the research we've done recently kind of, I think, affects this discussion as well. We've studied various measures of corporate purpose based on consumer assessments of companies, and we've been able to show really strong positive relationships between companies that rate highly on corporate purpose and what that means for growth, for margins, for economic profit, for total shareholder return. Very positive relationships, and those relationships got stronger during the COVID crisis. So the importance of being a kind of a good company is very important. And I think one of the reasons this happens is because a lot of the younger, all employees really, but a lot of the younger employees really want to associate with a company that doesn't just make money, but does good things for society. And so you wind up attracting people and retaining people, when you're a good company that operates with good corporate purpose. I often say corporate purpose is to a corporation like personal character is to an individual person. And people like to associate with people with good character, and they like to associate with companies that operate with good purpose. And so I think a lot of what's happening with sustainability initiatives and ESG and so forth, really has a very positive impact on the ability to attract and retain people. And once they've decided this is a place they want to work, I think the idea of trying to fit in with an ownership culture actually suits them quite well. I don't think, if they don't believe in the company, I don't think they're going to want you trying to get them to act like an owner. But if they believe in the company and what the company's doing, not just again for the shareholders, but for all stakeholders, I think that the culture of ownership fits very well.
I would agree. I'm sorry. I was just going to say our sustainability push is a huge attraction for a lot of these younger folks. To your point, they want to be part of something that is bettering the world. And we believe, selling the most sustainable products in aluminum containers is that. And I think that's a huge factor to young folks being attracted to our company.
Great, thank you. I'm going to just advance this to my contact details. And again, if anybody wants to reach Scott or Gary, you can reach out to me and I will forward messages to them. Scott, do you have any closing words? I've got a couple of things I want to say to close, but do you have anything you'd like to say?
Just that, this seems pretty simple. We've been doing it, like, to your comment, back to the early 90s, almost 30 years. To me, it is the single most important thing we've ever decided to do as a company, because it drives just so much behavior, the right kind of behavior. And I attribute the vast majority of our success is to follow and pursue EVA or economic profit and be consistent and do it over a long period of time and get people to buy into that. It's an incredibly powerful tool. And frankly, I'm surprised sometimes when you meet investors and they don't understand how we get paid and how our incentives work. To me, that's the most important thing, because that drives the behavior. So for us, it's led to the success that we've had.
I think that's great. And I don't have much to finish on, but let me just say a few things. I have been doing this myself for almost 30 years now, and I've been really impressed with the behavioral changes that we see in companies that we work with, and how people really do start to think and act more like long-term committed owners. I know the audience, is probably mostly from a finance and strategy background. And I think many times when I speak to people with a finance and strategy background, all the questions are about how do you calculate the measure, and what do you do about these reserves, and how do you treat depreciation and R&D and taxes, and all those things are important to get a measure that's accurate but also simple enough that people can really understand it. But at the end of the day, you have to remember that the objective is behavior. The objective is to get people to think and act differently. And we believe getting them to think and act more like long-term committed owners just leads to better results. And it leads to people being more conscious of the sustainability side of things, because they care a lot about what the company looks like 3 and 5 years from now, not just worrying about next quarter. So I'd like to thank everybody for joining today, and I'd like to thank Claudia and Marcus Evans for organizing this event. I hope you all have a great rest of your day.